probably
let's
be
do. Let's. We got a lot to cover, so let's do introductions.
right.
And
We should probably get to that, right? So let's fast forward to BIOS for a moment, and we can get that part out of the way. There's also the disclaimer, right? The disclaimer is important. What kind of lawyers are we if we don't have the disclaimer? The disclaimer is that anything you hear on the program today is not legal or tax advice intended to be used without being officially advised by a qualified professional. This is especially important for today's program. Under normal circumstances, I kind of like poo-poo this a little bit, but this is pretty serious for today's program because we are out in the wilderness in cutting edge territory. So I don't want folks to come back and take any of this necessarily as gospel, not only because that it's unresolved at the moment, but because any future guidance could change what we say on this program, and this program is also being recorded. So the disclaimer is important. So let's now go to BIOS for a sec.
Yep, very important. And this will be recorded and put up on YouTube. So if you're watching this, after today, August 26th, then, just the world will change between now and then. So
I don't think there's any question about that. Right.
And same deal. We're not recommending that you do anything here. We're not it's all at your own
risk. No
investment
advice either. Precisely.
Exactly.
Yeah, that's important stuff. This is the firm. Yeah, I mean, so this is the firm. This is me, and my ugly face, which you have to see twice. I apologize for that. I am Matthew Rappaport. I'm vice managing partner of Falcon, Rappaport, and Berkman PLLC, which is our esteemed law firm. We concentrate our practice in interdisciplinary and multidisciplinary matters. We advise all sorts of folks, including investors, dealers, sponsors, and other folks in the cryptocurrency and emerging tech world. We're also heavy into real estate. We're heavy into regular tech, or what you might call vanilla tech. That includes fintech. That includes all sorts of other stuff in the tech world. We handle crossovers between tax law, intellectual property law, wills, trusts, and estates law, corporate law, securities law. We like to think we have almost everything. We don't quite have everything, but we have almost everything that our target clientele is really looking to get advice on. My department in particular is tax and private client. So I do matters involving the income tax, the estate tax, and the gift tax. And the program today is going to get as deep as we can possibly get on what we think the tax consequences and tax implications are of crypto, NFTs, and other fun stuff that goes on the blockchain. I'll say something about myself, however. This is really important. So my three colleagues who are on today, and in particular, I want to give a shout out to Lewis and to Simon, who put a lot of these materials together and did a lot of the yeoman's work on it. I am what a lot of folks who are real enthusiasts in this area might call a dumb normie. I don't own crypto. I don't own any NFTs. I also advise on a lot of real estate, and I actually don't own any real estate. So I am a dumb normie. What that means is, in preparation for this program, we had a ton of discussions in which I, the dumb normie, had to be informed from scratch how a lot of this stuff works. So anytime that you hear a dumb normie moment out of me, Moish is going to step in and be like, no, you are unenlightened, and this is actually how this stuff really is supposed to work. So any mistakes I make in speaking on how some of this stuff works mechanically are my own. Another note that you should understand is you may hear some of the stuff and you may turn around and be like, wow, that is really unfair, or wow, that sounds counterintuitive, or wow, that sounds like a total burdensome obligation that the government puts on us. And to that, I respond, welcome to the American tax system. Yes, it applies to you if you have jurisdictional relevance to the United States. Yes, it applies to you. Yes, it's unfair. Yes, it's burdensome. And yes, it's real. And if you don't deal with it now, the chances are that you are going to have the government come force you to deal with it, which is not an enviable situation. So so that's me. Moish, you want to go to your bio and your much better looking face and
Yeah, I think the photo makes me, you can compare side by side and draw your own conclusion. So my background is in intellectual property. I've been doing that basically out of law school. And then in 2014, one of my buddies said, I'm doing a cryptocurrency startup. I want you to join. I don't want to hire an attorney. So I did that. We failed, but it got me to buy cryptocurrency and fall down the rabbit hole, which seems like every year or two, it gets exponentially more complicated. And then I was just in my day job doing intellectual property law until the beginning of this year, when all of my interests in intellectual property and cryptocurrency merged with the prominence of NFTs. and with the prominence of clients of mine saying, hey, I'm doing something wacky and wild in the world of NFTs. So very quickly, I and our firm ramped up to, we have clients that are NFT platforms, artists, creators, global brands that are looking to do something in the NFT space. Myself, Simon, who's on the call, Lewis, Matthew, we help them figure out from a traditional world what they need to do to be compliant with tax regulations, getting terms of service, license agreements, agreements with between entertainers, people that are whatever it is that they need. We're trying to be the resource that we can to connect the traditional legal world into whatever they're doing in this wild west. In addition, I personally invest in cryptocurrency, NFTs, and we'll talk a little bit about that later. So keep moving on. So the kind of the meat of the program today is going to be a high level cryptocurrency NFT, just overview, like what the things are. We don't know, there's generally when we give presentations on cryptocurrency and NFTs, about half the room has no idea what we're talking about and is here for, basically to learn. And half the room is like, we only want to know about the really fine, like really specific thing that I'm involved in, which is really complicated. So we have to kind of like balance that. So bear with us. We're going to try and run through really quickly just what NFTs are, which I think even if you know what they are, it's going to be beneficial when you get to, some of the tax consequences. So let's get started. So I think of it, cryptocurrency, NFTs as a pyramid, right? So you got the blockchain is the infrastructure layer, which enables cryptocurrency coins to run on top of that. And then certain types of blockchains enable smart contracts, which allow for tokens. So we'll continue. A blockchain is a distributed database, which means that each transaction in the database confirms the prior transaction. So here you have a slide where there's a genesis block, which generates a hash. That hash is used as an input into the next block. And as this database goes on, it gets more secure because you cannot falsify each transaction. And so this is, you send one NFT to a person, and this is going to confirm that transaction. And you can always provably show that the NFT went from, point A to point B to point C, and that's going to verify ownership. Same concept for transfer of coins like Bitcoin. So Bitcoin NFTs are all following this fundamental, model on the infrastructure layer. So getting into what is a cryptocurrency, right? So Bitcoin, for example, is using the Bitcoin blockchain to do just that, right? It's being used as a currency. In fact, the Bitcoin white paper, which if you have not read and you want to learn more, that's the best place to start. A peer-to-peer version of electronic cash without going through a financial institution. So that's the goal as explicitly stated by Satoshi Nakamoto, who I think Matt has some guesses as to who that is.
I don't have any guesses. I was just telling you, look, all the enthusiasts know this, but like Satoshi is like it's a pseudonym. It's a nom de plume. Like it's not even a real person. So it's a real person who did all of this. It's just like Satoshi Nakamoto is not the person's real name.
Or people.
Which
I think it's
I've found perpetually fascinating. Although, as you mentioned, Moish, now the Satoshi wallets apparently control like billions of dollars worth of assets, which there's a lot of interest around who this person is or persons. It could have been multiple people just going under a like Shakespeare.
Yeah, exactly.
Multiple people under a pen name.
That's right. So look, Bitcoin, it's cash. That's all it is. It's not we're not doing Bitcoin NFTs. If we want NFTs, we got to get to smart contracts. So again, the Ethereum white paper, Ethereum was only created in 2013, which somehow seems like forever ago, but also like that's not that long ago, right? So Ethereum was explicitly proposed as a next generation smart contract and decentralized application platform. Again, if you want to learn more, start at the white paper. A lot of people just skip over that step. You should read it. And what that does is it creates an automatically executable computer program, which is executed on the blockchain, right? So the blockchain is executing computer programs. In our case, NFTs are a type of computer programming, and the metadata of that computer program points to an image, which would be the visual component of that NFT. The computer instructions are going to self-execute on the public blockchain, the Ethereum blockchain, instead of a private computer. and your computing costs, transfer costs, transaction costs are paid in the native cryptocurrency of that blockchain. So for Ethereum blockchain, it would be Ether is the native cryptocurrency. But in addition, the smart contract functionality of the Ethereum blockchain allows all sorts of things, all sorts of different tokens. So I like to analogize the smart contract to a vending machine. You put a dollar bill into the vending machine, you press a button, the vending machine takes, if you put in $1 and press a button, I will give you a bottle of Japanese tea. Like that's what it's programmed to do. If you fulfill that condition, it'll return it to you. So smart contracts work the same way. If you put in cryptocurrency, I'll return a different cryptocurrency, or I'll do some other function, right? So that's what we have, right? We have tokens running on smart contracts, running on the blockchain. We have fungible tokens. We have non-fungible tokens. A fungible token would be something that's analogous to real life currency, $1. If I owe Matt $1, he doesn't care if I pay him for quarters or a dollar bill or which dollar bill I use to pay him. He is a debt, and I satisfy the debt by paying any fraction of that. Doesn't matter which dollar I give him. Same with gold, right? It's all interchangeable. I need a certain weight in gold. You give me that weight, then that's it. Non-fungible tokens are different, right? So each token is unique. If I ask for someone to send me a non-fungible token, they can't send me a fraction of one, although we'll get into fractionalization, but it's a single object that's unique, like a parcel of real estate or a trading card or something like that in the real world, right? So this is a digital way to create unique objects that are not interchangeable. So here listed, we have a sampling of some of the NFTs owned by persons at the firm, which conservatively have an uncomfortably large value at this point. So, if anyone wants to talk about the specific aspects of different NFTs, we can get into that too. And then one of the other topics of this discussion is decentralized finance, right? So thinking about exchanging like that vending machine, right? This is a callback. Here you have a visualization of what the Uniswap platform looks like, right? So if I have Ethereum token, I can exchange it for the US dollar token, which is a fungible token, which runs on the Ethereum blockchain. Actually, USDC itself runs on Ethereum. So Ethereum blockchain allows different tokens like Ether, like USDC, and you can change one for the other. And so we'll get into the taxation of these types of transactions. Just really simply though, if you want to take a step back, a non-fungible token is a new way to track digital ownership and provenance. And each token is distinguishable, and each ownership, the ownership of each token can be tracked separately. Again, if you want to learn more about what that means, and the best place I think is EIPS, which describes the standards for these, and you can kind of jump off from there into further reading. So how did I do, guys? Should I? That's a lot of information.
You made pretty good time.
Yeah.
Because I think for a lot of people that are really enthusiastic about this, that was basically not new information to any of them. But at the same time, we felt for everybody who's coming onto this and it's a brand new topic to them, or at least they know a little bit like I did, hopefully that was pretty helpful. Because for the next 45 minutes, what we're going to do is we're going to dive pretty deeply into a lot of this and start speaking technically. So we hope at least that gave people enough of a background to keep up. So.
All right, so just some visual examples. I'm a visual learner. So, here's a CryptoPunk talking about taxes. We're talking about taxes because NFTs now mean big dollars, $7.5 million sale, right? It's one of 9 aliens punks. So that seems pretty obvious to me that, NFT, we have NBA Top Shop NFTs that just thinking about using cash. We have gaming and gambling and racing horses. So, you think about, Matt, I think there's a whole cottage industry about taxation for traditional horse racing. Well,
that there is.
Yeah.
And if we've got interest, put your interest in the Q&A panel, because I can riff on the taxation of horse racing also if everybody wants that. So yeah, it's a horse racing has its own it's got its own bunch of case law about, and the primary horse racing question really is, are you doing it as a hobby? Are you doing it as an investment? Are you doing it as a trade or business, right? That applies to artwork, which is NFTs. Some of the NFTs are works of art. And it's going to apply to folks that we're going to talk about who are in unboxing and other related things that you can probably tab as a trade or business in the world of the blockchain. So horse racing is a pretty good analogy at the end of the day, and then virtual horse racing is probably going to have some of the same tax issues as physical horse racing.
All right, and then, this is kind of sums up why we're here today, right? So I personally think this is a beautiful work of generative art, and but whoever bought this thing in June for 0.58 Ether, which is about $1,300, and then sold it this past week for 1,000 Ether, $3.3 million, has essentially a $3.3 million gain in 2 months that they're now going to have to account for. So it's beautiful, it's fun to collect, but there's real world implications, there's real world money, and we would suggest that if you're talking about these kinds of numbers, you should be talking to a tax attorney to figure out what it is you can be doing here. So before, I think now we're going to be like diving into specific examples, the day in the life of an Ether. That's the title of the presentation. Matt, you ready? Let's go.
Ready as ever.
All right. So starting off here, this is pretty typical. Everyone's first start. This is how they're getting their Ether. They're going to Coinbase. They're buying, $1,000 of Ether through Coinbase. Their basis is $1,000, right? Is that inclusive of fees, Matt?
So as far as your $1,000 basis, the general rule is that at least in the world of, traditional investments, I might say, generally you get to include fees into basis, right? So you're buying shares of stock and whatnot, right? The general rule is you include your fees and basis. Here, you go in, you purchase crypto, you get to include the fees you pay in Coinbase and such into your total basis, right? In addition, we have to back up for a second. We have to talk about one of the foundational concepts, which I'm sure a lot of folks here are aware of, and that is the IRS notice in 2014 that said cryptocurrency is going to be treated as property for general federal income tax purposes. What does that mean? What that means is that if it's not money, it has basis, right? Money doesn't have basis. Money, you can't have in the disposition of just money. If you pay money for something, right? You're not going to have a taxable event with respect to the money that you paid. It's just not the way the system works. The system is built off the idea that money is not only fungible, but money is also going to be the main medium for exchange as legal tender in the United States. For that reason, money does not have a separate basis, but property does. Basis is the income tax concept of what is my reference point for determining how much money I owe when I dispose of something, right? And getting into the idea that there's a whole world of what is a disposition and what isn't. We covered that in this program also. You have to ask yourself, well, if I'm disposing of something and I have to pay taxes on the money or other property I receive when I dispose of property I own, what's my reference point for determining taxes? And that is where basis comes in. And basis, especially with respect to things like real estate, basis can be adjusted up or down. When it comes to intangible assets like crypto and NFTs, basis is generally not going to be adjusted up or down. It's a rare circumstance, I think, in which your basis of your NFTs or your crypto would change. But if you want to take basis of a different type of intangible that you come across every day, you would think about stock. When you buy a share of GM stock, right, inclusive of fees, you buy it for $10. Now, when you buy a share of GM stock for $10, that's your basis. You're not going to get taxed for the original $10 you paid for it. That's not fair. If you sell the share of GM stock for $20, you're going to pay $10, or at least you're going to pay taxes on the $10 of gain, right? That's $20 of what's called my amount realized. Don't get too caught up in the legal jargon. But I received $20. I had basis of $10. My gain is then $10. 20 minus 10. I then apply the right marginal rate of tax to that $10, and that's how much I owe the government. That's on the federal level. If applicable, that's on the state level. If you're in a jurisdiction where the state levies its own income tax on you, you pay the federal government, you pay the state, and in certain instances, like in New York City, Philadelphia, a few other places across the country, on top of the federal and the state government, the city government actually levies a tax also. So your basis is really this universal reference point for how much really do I have into this thing? That's the best way you could think about it colloquially. How much money is into this thing that I shouldn't be taxed on because that's how much I laid out? It's like, I'm not going to get taxed on that money. That was the money I laid out for it. So if I have in this slide here, I got Ether at 1,000, right? Then if I were to go ahead and have a disposition event where the Ether is now worth $1,500, a $500 gain on the Ether, right? And that's how much I get taxed on. But since the Ether is property, right? The use of Ether in a subsequent transaction is a taxable event. If the value hasn't changed from your basis, however, then the taxable event is just a zero event, but it's still a taxable event. So underpinning a lot of what we're discussing today is there's a 2014 notice out there that says for tax purposes, crypto is property. It is not currency. It is not the equivalent of United States dollars. It is property. And therefore, every time that you have the acquisition of crypto like Ether, you must keep track of basis for it. And every time that you dispose of Ether, there is a taxable event. You have to figure out how much you owe in taxes. And even if you owe nothing, you still really have to go ahead and make sure you're keeping track of it because the government is going to ask for records if you ever get audited. But as is mentioned on this slide, the mere purchase of Ether is not a taxable event because, as I mentioned, cash doesn't have any basis. And when you lay out cash, you receive the Ether back, right? You're just getting $1,000 basis in the Ether. That's simple. So I think, Moish, that's probably all we need to spend on this particular slide. But that we may as well start with the simplest concepts behind this, right?
Yeah,
so Moish, take us through what's on this one.
Yeah, so this would be a simple one, right? So you buy in Coinbase, and now in order to buy NFTs, you need to put it onto a MetaMask wallet, which is going to be, or another hot wallet or some other wallet that's outside of the centralized exchange. So here we have a picture of MetaMask, which is one of the more popular wallets, and you're transferring from your Coinbase wallet to your MetaMask wallet. So, hypothetically, the value of Ether is always going to change between those two transactions, even if slightly. But I think the sum here, Matt, right, is that you're like an internal transfer from like your checking to your savings account, and there's not going to be a taxable impact to that.
Yeah, this strikes me as pretty simple. When you're switching your crypto from wallet to wallet, there's no disposition because there's no what's called a sailor exchange, right? That is, in tax parlance, that's where a taxable event really comes from. You can not only have an actual sailor exchange, you can have a deemed sailor exchange in certain cases. We'll talk about that as it comes up in the world of Ether. But going from wallet to wallet is not a sailor exchange. Simply changing your property from custodian to custodian is not a sailor exchange. So this is a very simple example, but going from wallet to wallet with your crypto is not a taxable exchange.
And so that would apply to NFTs as well.
It would apply to NFTs as well, where you're going to change custodianship of your NFTs. The fact of the matter is that you still own the NFT. You haven't sold it. You haven't gotten rid of it. You haven't exchanged it for a different NFT. You haven't done anything with it. So when you switch from wallet to wallet, this is not a taxable event. The interesting thing that we get into later on in the presentation is when you switch blockchains, right? And that's where we think the fungibility of crypto versus the non-fungibility of NFTs actually makes a difference in our estimation, because this is stuff the IRS has not commented on. So let's keep going. We'll eventually get there.
Okay. So here we have swapping for different currencies. So I showed a slide earlier on what Uniswap was. Here you have an example of you're changing from Ether to Matic to get on the Polygon network instead of Ethereum mainnet. So you're swapping your ETH for Matic. So Matt, what do you think?
So this is right. This is the first thing that you start getting into that is not incredibly screamingly simple, and it's also where I think a lot of normies heads start spinning. Right? I have one type of cryptocurrency. I have ETH. Right? Then I'm changing it for Matic. Really. So I want to go from one set of capabilities to another, from one blockchain to another. So what Uniswap as a platform allows you to do is it allows you to say, listen, you need liquidity, not in the form necessarily of going from crypto to cash, but from going from crypto to crypto. The way the IRS is going to treat this, based on the 2014 notice that we mentioned a couple of minutes ago, is you're now exchanging property for property. And this is where, when you're not a normie and you're a big crypto enthusiast, this is where your sense of fairness probably starts ringing alarm bells with you, and you start saying to yourself, like, wow, this is insane that you would tax this, but they tax this, okay? Based on the services position, the swap of ETH for Matic that you see on your screen here is a taxable event. Now, go back for a second to the concept of basis, right? I got $1,000 worth of Ether, but I have exchanged it for, because now the Ether, based on its fluctuation value, is worth $1,220 roughly. So when I get the Matic out of my exchange, I'm getting $1,220 worth of Matic. Although you see here that in the time that it took to process the exchange, there was a little bit of fluctuation in Matic's value. I happened to get a little bit more Matic than otherwise. But here, the ETH started at $1,000 a basis. You exchanged it for $1,220 worth of property. I have a $220 gain on the Ether. That's where I think a lot of crypto enthusiasts turn around. They're just like, WTF, this is stupid. Like, why am I getting taxed when I'm really going from one blockchain to another? There are two different types of cryptocurrency in the same asset class, right? But this is taxable. This is a taxable exchange of property for tax purposes. Let me go further on this. We have a little ditty on this later on in the presentation, but as long as it comes up here, Section 1031. Let's talk about the applicability of Section 1031 to the exchange that you see in front of you. Section 1031 is part of the Tax Cuts and Jobs Act of 2017, which had an effective date of late December of 2017. Okay, that restricted 1031 only to real property. 1031 does not apply to swaps of cryptocurrency past December 27th of 2017, but I could be wrong about the exact date. Either way, prior to that, the IRS came out with a revenue ruling in 2019, and they gave their thoughts on an example 1031 swap prior to the TCJA's effective date in terms of crypto for crypto. But you gotta realize, if any of you are dealing, because it's not going to happen from here on out, but if any of you are dealing with a 1031 that may have occurred prior to the Tax Cuts and Jobs Act's effective date, you have a maze of compliance to navigate to see whether or not 1031 is actually going to apply to your swap. If it does, the swap is not taxable. Instead, the gain that would have been taxable that I just talked about on this slide is now deferred. Your basis carries over. So in a 1031 exchange, the Matic you receive for your ETH has a $1,000 basis, and your $220 gain is carried over until you convert your crypto back to cash or otherwise do a taxable exchange. But post Tax Cuts and Jobs Act, for every taxable year 2018 and forward, this is a taxable exchange that you have in front of you. And every crypto for crypto swap is going to be a taxable exchange unless you're swapping one item of fungible crypto for the same fungible crypto for whatever reason. And Moish, you can chime in to say whether or not that would actually ever happen. But if you swap ETH for ETH, that is not taxable. You swap Bitcoin for Bitcoin, that's not taxable. But Bitcoin for ETH and back is a taxable event. And that's fundamentally, you should understand that, right? And we're trying to put these slides together to build up to more and more complex concepts. But tax-wise, everybody should understand, swap of crypto for different crypto is taxable.
Okay, so just going back, there's a good question here about
couple good questions.
A couple of questions. We're going to cover these. All right, so here, right, you swap from one wallet to another. You have a $1,000 basis. You move to your MetaMask and you pay for moving a $10 transaction fee. Are you adding that to your basis? Now your basis is $1,010.
I would say no. I would say that is a Section 212. And forgive me, by the way, because this is how my tax mind works. I drop references to the Internal Revenue Code. I can't help it, okay? That is probably, if you hold the Ether in this example for investment purposes, okay, that is a Section 212 expense that's generally related to assets that produce investment income. In my mind, that is deductible. You would not add that to basis. It is only the initial acquisition cost you would add to basis. So spitballing an answer to that question, that would be my answer. My answer is that when you already acquired it and you've closed the acquisition, now you're going ahead and you're paying a $10 fee to transfer. That $10 fee should be deductible.
Okay. And then there's someone else commenting that the gas would be added to the basis. So I think it, maybe you can argue both sides of that. And it might
I would argue at the end of the day, that's probably deductible. Because when you think about this, right? Think about this in the real estate world. The mere change of custodianship, or the mere repair, the facial repair or maintenance of a real estate asset is deductible. Any change you make fundamentally to the real estate, and certain acquisition costs of real estate to be built, are capitalized into basis, right? So this is in tax world, this is a relatively complicated question, deductibility versus capitalization. But I would say when you're switching wallets, a $10 fee you pay should be deductible. It's a mere payment you make for the transfer of the asset and the custodianship of the asset and changing it. So I would err on the side of deductibility in talking about that. I should mention for the record, so as I look at the attendance list, Professor Annette Nellen is on this broadcast from San Jose State University. The first person who I ever heard mention crypto in the tax world was Professor Nellen. So Professor Nellen's here, so hopefully she can chime in the chat with some of this if she knows a lot of these little nuances pretty well. But she really is an excellent tax practitioner and was really ahead of the curve on crypto stuff and NFTs.
Okay. So there was a question about, well, what if we're just moving Ether to wrapped Ether, right? And there's a bunch of things you can do, and we'll get into these different DeFi transactions.
Yeah, this
right?
is where it starts to get like at least moderately interesting, right? Is where you start to the concept of wrapping Ether. So I mean, Moish, you want to start getting into like what is even wrapped Ether?
Yeah. So the idea being, the main net of Ethereum is quite congested and can be very expensive to use. So you would wrap your Ether into basically a different, like a side chain to the Ethereum main blockchain, and that would allow your wrapped Ether to transact on that blockchain for either saving you fees, or there might just be different applications that prefer wrapped Ether to play with them, right? So like Zed Run, the horse racing example, is one that you need wrapped Ether in order to buy your horses, and presumably they do that because there's all these transactions happening, and it's way cheaper to do those transactions on the wrapped Ether, on that blockchain versus on the mainnet Ethereum blockchain. So, but the idea of Ether and wrapped Ether is they're essentially the same asset. They have essentially the same US dollar value from any time to time, but there is slightly different functionality because they're, one is functional to the Ethereum mainnet blockchain, and one is and one is not, right? They have different ultimate functionality, at least slightly, right? Otherwise, you wouldn't be wrapping and unwrapping.
So what I was doing while you were giving the rundown of wrapped Ether was there's a couple things that I should announce. The first thing is we will, as Moish mentioned, be putting this recording up on YouTube. So for anybody who's worried about accessing the recording, we're going to circulate around the YouTube link. Second, our slides available, definitely. We are going to distribute slides to all attendees. In addition, if you want to contact somebody for the slides, Lewis, can you put Abby Winkler's email in the chat to everybody? So if you'd like to get the slides, email Abby. Abby's gonna have the slides. She'll be able to distribute them to you. So those two announcements are crucial. So I just want to make sure, because we see a lot of stuff coming through on chat for that. Second thing I see coming through, by the way, is a common theme in the Q&A is, are there any tools that we recommend in order to track all of the tax attributes of crypto? I mean, Moish, I've seen a couple things out there, but maybe this is the clarion call for us. This is our next $1 billion idea, and we can quit the legal business finally.
Yeah, I mean, there's a few out there that are good for crypto, like base crypto transactions, or at least I'm told they're good, and DeFi transactions. I know like Token Tax, there's a few others. I think a lot of them have similar functionality. As far as I know, and if anyone here knows differently, none of them have like specifically like built out like an NFT specific solution. I personally will be looking for that solution. Hopefully by the end of the year, one of these companies will roll that out and make that more user friendly. But as far as I know, that isn't quite broadly distributed yet. If someone here knows differently, that would be great intel to share. But yes, there are tools out there that will basically like say what are your crypto addresses, and then run through your transactions and kind of spit out a result of like based on the transactions you had, everything's on the blockchain, right? So it's all on a ledger somewhere, and it can just review those transactions and tell you, we estimate your taxes are X number. Now, whether that's actually accurate or not, and depending on the complexity of what you're doing, you may need to go like line by line and like double check, and hopefully you've kept written notes and things like that where you can confirm that everything's accurate and so forth.
Moish, before we get into Wrapped Ether, there's one other thing that I should mention about the tax software. The tax software is going to track numbers for you, but it's not going to track things like, are you an investor? Are you a dealer? Or are you somebody who's holding these things merely for personal use? We have a slide on this, but I'm just going to let you know. If you want to talk about, as far as our services, right, shameless plug, as far as our services in terms of helping you figure out what the tax treatment of some of this stuff is, that is a fundamental question that's going to determine the tax treatment of any transaction you do involving crypto or NFTs. So I should put that out there. As much as the software is going to track all the numerical stuff and the quantitative stuff for you, the qualitative stuff is where the lawyers come in. So I just wanted to put that out there. Anyhow, right? Okay. So the question is whether or not wrapping fungible tokens is really a contribution to a partnership or itself a taxable event. Okay.
Well, so there's two things, right? Just to cut you off, there's the wrapping and unwrapping, and then there's like providing liquidity to a liquidity pool. So those are two different, so let's make sure, I just want to make sure.
Yeah, so for me, right, I want to talk about first the notion of this liquidity pool, which in my mind, right, what you have here, and tell me, Moish, if I'm describing this correctly, is the ETH and US dollar coin are put into the liquidity pool. And in exchange for providing these tokens to the liquidity pool, you're receiving what you have in the bottom left here is these fees, right? And these fees are distributed pro rata to everybody according to how much ETH and US dollar coin they have contributed to the liquidity pool. Okay. Now this is wrapping my normie head around this. And let me make another point about normies. Okay. Not only are a lot of the tax lawyers normies, but the entire IRS is normies. Okay. You got like the whole IRS, you're talking about like anybody in the IRS. If you got two people in the IRS who understand crypto to this level of detail, you're lucky. And the reason is not because they're not capable. A large sampling of the best tax lawyers in the country works at the IRS. That's not, the technical ability is not the problem. The problem is these folks don't get involved in crypto and NFTs like this. And when they take a look at it and analyze it, they're going to analyze it like I did with Moish, Lewis, and Simon, which was, okay, tell me what this is. And then once I take a look at what this is, I'm not looking at this from the perspective of participating in it. I'm looking at this from the perspective of enforcing it. Okay. So if you're going to sort of look at this and say like, oh, like your normie judgment means that you don't understand anything, like you're going to get the same stuff out of the IRS anyway, and they have the ability to levy taxes against you. Okay. So I want to make that clear. But when I look at a liquidity pool, I see a tax partnership. Moish, do we have the 761 slide? Let's go.
Do we have that?
So I don't know, because this would have been, this is a Lewis and Simon question.
Yeah.
Do we what?
Yeah. 761
Okay.
slide.
There we go, right? Boom, 761 slide. Let's take a look at what a tax partnership is, okay? Tax partnership includes any syndicate, group, pool. Okay, the word pool is in there. Joint venture or other unincorporated organization through or by means of which any business, financial operation, or venture is carried on. Okay. Now, what you can do is you can make a 761 election. Okay, if you have these three features that you have in the bullet points here. If you're doing it for investment purposes and not to conduct a business, and if it's for the joint production, extraction, or use of property, but not to sell services or the actual property produced. So go back to our liquidity pool for a moment, okay? Go back one slide to what we had in the diagram. A liquidity pool, in my mind, is a tax partnership unless you elect out of it. You might be eligible, you might not be. What's going to determine this is whether or not the liquidity pool is a mere passive venture involving the crypto that is put into it, or whether it is a little bit more active than that, right? The payment of fees and the investment returns on this, is really going to depend on whether or not the persons running that liquidity pool are really going in and sort of actively doing a lot of plumbing to facilitate the liquidity that the pool is generating, right? The thing is, when you have a pool of persons who are putting crypto together for purposes of generating liquidity, but there's really one sponsor or master of that pool who's doing all of the plumbing necessary to make all that happen, that's a borderline case if there ever was one. And one of the things that the pools might want to do that I suspect that they're not doing is make a 761 election out of partnership treatment. Because let me tell you what partnership treatment means for all of you, okay? If you have your crypto in a liquidity pool and it is a partnership, you're going to need to get a K1 from that partnership. The partnership's going to have to file its own tax return and report all that fee income, and then distribute all of the income to all of the different people in the pool and allocate it on the tax return so that when you receive a K1, you can attach it to your own tax return and report the income from it, right? That is the belt and suspenders proper tax reporting for a liquidity pool in my mind. That's number one. Number two, if the liquidity pool gets audited for any reason, whether or not they think its expenses are bogus, whether they want to go ahead and verify the income, or any other reason, the Bipartisan Budget Act of 2015 changed the rules for how the IRS mechanically conducts partnership audits. Now, the way a partnership audit is conducted is the partners don't really have rights. Instead, the partnership has one partnership representative. That representative is responsible for all communications and all decision-making related to that audit. They don't even have notice requirements back to the partners. The partnership representative can come in and conduct that whole audit and then resolve it unfavorably to you if you're a partner without your knowledge and without your consent. That's crazy, but it's a convenience rule for the IRS. Because the old rule said you got to go back to all the partners. All the partners have rights. They have notice rights. They have all these other rights. And as partnerships got more complicated in the last 40 years, the government changed rules and said, you know something, this is way too hard for us. Complex private equity funds, hedge funds, crazy stuff. It all became way too complicated to do an audit. So we're changing the rules. The rules are now that one person will be the representative for this entire audit. The partnership gets audited as a unit, and any deficiencies the partnership has to pay, it has to pay as a unit. Okay, if you don't have an agreement among the partners because your liquidity pool didn't draw up a governing agreement or elect out a partnership treatment, your partnership representative is not designated by the partnership itself. What that means under the rules is the IRS can designate the representative for you. Luckily, there's rules saying the IRS can't designate itself, but it's going to probably designate the person running this thing and not you, right? And the thing is, the whole point is, in my mind, the liquidity pools have to do more tax compliance work to make sure they don't fall into this. Because if you do fall into this, everybody in the pool is probably going to get screwed if you get an audit. And I think the government is going to throw its weight around on a lot of these because the government tends to approach a lot of these things ham-handed. And I think that every liquidity pool should make a 761 election out of partnership treatment. And all of these fees should be reported back to everybody as via 1099. And that's a lot easier. That's everybody gets audited individually. If somebody has a problem with the audit, they're going to go audit you as the participant in the pool. Or if they audit the pool, they're going to audit the pool without any impact on its participants. But maybe the sponsor of the pool. But you don't want partnership treatment for this. And the first thing I thought of when these three gentlemen who are my co-panelists explained to me how a liquidity pool even works and what it is I said, that's a partnership.
Yeah,
Moish,
this is like one of those examples where it's just so divergent from the user expectations from like, I'm just putting money in a liquidity pool and I get 0.3% fee and come back and I go my separate way. Like, why would that be treated differently than anything else I'm doing in the crypto world? But, I guess we'll have to see how that gets resolved, because from what you're saying, it just seems like, well, nobody's doing this. None of these liquidity pools are even considering providing 1099s, and I just get my 0.2% and move on. But it may not be so simple, I guess is the conclusion.
And Moish, I want to make something abundantly clear. If any of you on this broadcast run a pool, First thing you need to do is elect out a partnership treatment. Second thing you need to do is you need to make sure that there's tax reporting being done. Because I'm going to tell you, if you're not issuing 1099s for this, the government is going to give you a backhand slap when they find out about it. Because they're going to turn around and they're going to be like, listen, you have this entire venture going on. There's persons that are earning income from this. Just like an investment house gives you 1099s for the dividends you get, there is 1099 reporting required for this. And if you're not getting a 1099 from the liquidity pool, it means the liquidity pool is screwing up. And probably inadvertently and probably without any intention to do so. But I just think that a lot of these liquidity pools, from the sounds of it, because I have never participated in one myself, but speaking to my 3 colleagues about it, it sounds like folks are not doing this level of analysis on it. And you take a look at just the screenshot you have here, it's millions of dollars. It's easily worthwhile for the IRS to come back and go to the sponsor of the pool and be like, hey, nice thing you got here. Let's start getting some information about it.
All right,
And
we got a
that's
lot
going
to
to start
cover,
happening.
so let's continue. All right, so that was wrapping fungible tokens, right? So now, if you're in the NFT world, you can, well, there's wrapping of non-fungible tokens. That should be treated the same way, right, Matt?
Well, okay, so let's talk about, I think, another distinction, which was we went straight to liquidity pools. We didn't really talk about going from Ether to wrapped Ether. Here's the way that I evaluate this. And then I think Moish and maybe Lewis and Simon, you can sort of step in and you can tell me whether or not my thoughts are crazy. But again, this is normie world, okay? This is me, normie Matthew, coming in and taking a look at this just from a tax lawyer's perspective, rather than like, crypto enthusiasts coming in and being like, no, what are you talking about, right? So for a lot of you, this is probably gonna sound insane. But here's the way I view the difference between wrapping fungible tokens and wrapping non-fungible tokens. My understanding is that when you wrap an NFT, you're switching blockchains for the NFT. When you're going for fungible tokens, you're switching blockchains, but in doing so, you're actually switching the nature of what you have. So let me get deeper on that. Okay, Mooncats, right? Moish, go back to the Mooncat slide for a second.
Go back to the Mooncats, sure.
Mooncats are a variety of NFT. Every Mooncat's different, okay? So if I want to keep track of the ownership of my Mooncat on blockchain 1, but then I move it to blockchain 2, that does not sound to me like an actual sale exchange, because the Mooncat itself is the same. You're not getting a new Mooncat. You're not exchanging it for a different Mooncat. You're not whatever. You have the same Mooncat its ownership is being tracked differently. There's nothing inherent about the blockchain that changes the nature of the Mooncat you have. It's the same Mooncat. You're just changing the way that you track the ownership of it. That to me is fine. That is not a taxable event, because all you're doing is you're going from one blockchain to another as a matter of custodianship, okay? But now, Moish, go back to the idea of wrapping Ether. When you go from Ether to wrapped Ether, now in my mind, you have a different story, okay? And for a lot of folks, I think there's a lot of freaking out about what I'm about to say, but you have to keep in mind the burden in tax court's on you, okay? The burden's on the taxpayer. So when I see this, if I'm an IRS agent, okay, and you go from Ether to wrapped Ether, here's the difference between going from a blockchain 1 to blockchain 2 for Ether and wrapped Ether versus going from blockchain 1 and blockchain 2 for your same Mooncat. Ether and wrapped Ether are 2 different things to me on 2 different blockchains. When you go from the Ether blockchain to the wrapped Ether blockchain, you are changing the capability of what you can do with the token you have, okay? So my understanding of all this is the Ether blockchain allows you access to certain things, okay, that are just available to either purchase with Ether or you can exchange Ether for something else that's on the Ethereum blockchain, and it's a nice medium of getting a lot of these transactions done. If you want something, however, that you can only get from the wrapped Ether blockchain and not the Ether blockchain, you have to wrap your Ether. Moish, am I screwing this up?
Yeah, I think that's generally right. I mean, in terms of functionality, but the implications are just
pretty seismic,
counterintuitive.
Right? Because if I'm the IRS, I look at this and I'm saying, going from Ether to wrapped Ether is exchanging one type of property for another. Okay, so if you've got our day in the life of the Ether, where the Ether you have in front of you has $1,000 basis, and it's now at 32.33.42 in fair market value, and you now go to wrapped Ether, I'm the IRS. I turn around and say, great, you have a $2,233.42 gain in doing this. And for a lot of people who are wrapping Ether, you turn around and be like, freaking out, like, what are you talking about? This is insane. And I'm just going to tell you, under general tax principles, okay, I have exchanged fundamentally one thing for another. I don't have the same thing, right? Originally, Moish and Lewis and Simon were turning to me like, no, you don't understand. It's like pledging your property. right? Like you're pledging your property, and you're really it's kind of like refinancing your house. And I'm like, no, it isn't. Because if I'm refinancing my house, I'm putting up my house to a mortgage company in exchange for a mortgage, and I'm using my house as collateral. Here, I'm not using the Ether as collateral. I'm jumping blockchains. Now, Jonathan asks a really good question. What about when you don't change blockchains, right? Moish, explain to me the idea. Explain to the dumb normie on this panel. I wrap my Ether without changing blockchains. How does that work? Unless that's just unless that's not a concept.
I mean,
because I'm looking at your face.
Yeah, I'm trying to think. Simon, maybe correct me if I'm wrong here. My understanding is it might still be running on the Ethereum blockchain, but it's the Ether and the wrapped Ether tokens are different token. They're different assets. So you're going from one token to a different token. So you might be on the same fundamental.
Let's have
blockchain.
Simon chime in and enlighten us here.
Right. I think what Matt is saying is correct in that once it is wrapped, you are changing its inherent capabilities, and therefore it will be treated as a disposition of property.
Right. So that's the punchline, right? Let's go to the Cottage savings slide for a second, right? Because Cottage savings. This is unless you're Professor Nellin, I don't think any of you on here are tax lawyers. But when you're a tax lawyer, you're going to law school. This Cottage savings is like tax 101. Okay. Cottage savings is a 1991 case in the Supreme Court of the United States that talked about like what really is an exchange, right? And the Supreme Court clarifies it like this: it's a disposition of property when the properties exchanged are materially different. Okay, and the big takeaway from Cottage savings is in the middle of the slide. Even if the assets are substantially identical economically, they are materially different because they are not interchangeable in use. Right? My feeling is you've got Ether and wrapped Ether, right? You go from the Ether to the wrapped Ether, that is a sale exchange, okay? And I don't think you're going to be able to argue successfully against the IRS in court on that because of this case, the Cottage savings case. It's basic, but you can apply it to complex concepts like this. Now, Block Daddy, which is a very cool pseudonym, unless that's your birth name, which is even cooler, says Ether and wrapped Ether have the same value. Where's the gain? That's correct if the value of your Ether is the same as its basis. Okay, go back, Moish, to the slide for 1 second where you're wrapping your Ether at 3233, right? So if we can go back to that slide for just 1 second. If I'm wrapping my Ether at 3233, if I acquired the Ether for $1,000 of United States dollars cash, okay, I got a basis of 1,000. I have a fair market value of 3233. If I have a sale or exchange here, I recognize $2,233 of gain. That's where the gain is. Okay, tax-wise, that's why tracking basis is so important, and that's why you have to understand Ether and wrapped Ether are treated as property. This is an exchange of property. Now, if I bought the Ether for $3233 in cash and I exchanged it for wrapped Ether, I have a taxable event, but there's no gain. I don't owe anything, right? And that may be where you are getting at. Now, Aaron asks, well, in this scenario, doesn't it make sense to purchase the Ether with fiat and then convert to wrapped Ether, right? Yeah, sure, if you have the means to do it. Absolutely, right. because the exchange of and this is, I'm glad at least here that the attendees, it seems like, are starting to understand what we're getting at when we're educating people about this. But yes, if I go fiat at 3233 to buy new Ether and convert it to wrapped Ether, I've got a taxable event, but no gain. So that's correct. That is materially different from Ether that I bought for 500 fiat, or in our example, 1,000 fiat, that appreciates to 3233 fiat, and then I wrap it for wrapped Ether. That's a taxable event that's going to get you gain. And for the record, right, since every individual item of ETH is different property, you'll have different basis depending on the price you paid for ETH at different times. So that's another thing for you to understand, right? So let's keep going here because we want to make
let's get into the NFT transactions, because I think we got a lot to cover there, and we're running low.
And if, by the way, if folks will indulge us, we will probably bleed a little bit over, right? And as we mentioned, as we mentioned, the YouTube will be available, but we have to bleed over for this because we want to make sure that we're covering sufficiently all the stuff that we have in here. So
all right, so we just covered all DeFi. Now we're getting into NFTs, non-fungible tokens, right? So here we have our basis in our Ether was 1,000, and at the time of purchase, it's now 1219, right? So we have it's increased in value, the $1,000 in Ether by about $220. So you're buying here a Bored Ape for about 1 ETH all in at a US dollar amount of $1,220. So Matt, what is that? You have a basis in your NFT of $1,219.
Right. So that's the other side of this, right? We talked about in terms of wrapping Ether, you have a taxable event, but what that means is you step up your basis and you wrapped Ether. Here with the NFT, same concept. I have ETH that I purchased for 1,000 fiat. The ETH gets exchanged for the Bored Ape Yacht Club at a value of 1219.20. That's my amount realized. That's what AR says at the bottom left of this slide. And that is based, by the way, on the price of ETH at the time of the purchase, really, at the end of the day, because you're going to have an equivalent value swap. I have a $219.20 profit. I'm going to take that amount, apply it to my tax rate, and that's the amount of taxes I owe. Okay. In addition, what that means is that since I had a taxable event, my Bored Ape Yacht Club has a basis of $1,219.20. So if I sell my Bored Ape Yacht Club for $2,000, I subtract the $1,219.20, and that's the gain or profit I have on selling my Bored Ape Yacht Club.
Okay. Now, what if instead of you buy a pack for $9 and in there you get all sorts of different NFTs and one of them is worth more than $9? What's your basis?
Right. So we're progressively ramping up the level of interesting. Okay. I got the Greek Freak on the right at $164 in market value, but I only paid $9 for the pack. Here's the way it works. NBA Top Shot comes with 3 in a pack. So when I got a $9 purchase, each of my NBA Top Shot moments I have in there has a $3 basis each. The receipt of a Giannis is not a taxable event because it was the outgrowth of property I already owned. This is you can't be taxed on a sale or exchange with yourself. Okay. So when you open the Top Shot, you're exchanging the Top Shot you have for what's in it. But at the end of the day, it's like opening a pack of regular basketball cards. The fact that one of the basketball cards is inherently valuable does not make it a taxable event. It's all of this is happening inside of your own domain. It's not happening with any other party. So there's no real sale or exchange here. The receipt of the Giannis moment is not taxable, but it has a $3 basis. And if you sell it for $164, you do have a gain at that point that you have to pay taxes on. And that's important for you to understand. So let's go to the next one.
All right, so now we talk about ownership of an NFT might give you other benefits, right? So you can get an airdrop of another NFT. For example, if you own an ape, you get a dog. Or if you're a member of a club, you could get, perhaps some sort of financial benefit, right? You win a lottery type thing. You get access to a private event that's a $2,000 value, things like that. How do we
this is where we get to peak levels of interesting. Do we have on a subsequent slide, do we have the different scenarios here? Because not all scenarios.
Yes, we have a whole slide just on airdrops. So maybe you want to just skip over.
Yeah, so let's go slide by slide, right? Okay. And let's talk about each of the different scenarios that we have here.
It's a little bit different, right?
Yeah, believe it or not, right? The hard forks, the IRS has commented upon. So there's a 2019 revenue ruling that actually says what happens after a hard fork. And what they say is every time there's a hard fork, if you receive any new crypto from hard fork of crypto, you get taxed on the value of the new crypto. So when you had Bitcoin hard fork to Bitcoin Cash, if you did receive Bitcoin Cash, you're going to get taxed. But you don't get taxed if you didn't receive Bitcoin Cash. So they're saying you don't get penalized for a hard fork if you didn't actually get any property from it. You actually have to get the airdrop. If you get the airdrop, however, and the airdrop currency has a fair market value that can be established, you have to use that fair market value to pay taxes. So if you got airdropped $100 of Bitcoin Cash, all of it's taxable.
Okay, and so here we have just airdrops kind of generally. And the reason for that is creating some sort of benefit for holding, or perhaps distribution marketing, and then kind of the IRS argument there. So here,
and by the way, it's ordinary income as well. So the crappy thing about hard forks is it's ordinary income as opposed to capital gain.
So here we have two different kinds of airdrops, right? We have an airdrop on the left of a fungible token, right? So if you were using Uniswap, every user from a certain point in time had the ability to claim uni tokens, which were already trading at that time and had, at the time of claim, an identifiable market value. So you claim 400 uni tokens, say they have a $20 market value that is what, $8,000 you just pick up off the ground. So Matt, is that taxable?
The receipt of the uni tokens, if you know that they're coming, right? The case law basically says that if you have the uni tokens as basically a rebate, as an inducement to purchase, that's not taxable. Instead, you take the value of the uni tokens, if you can establish it, and you use that to reduce your basis. So if you paid $1,000 worth of ETH for your Bored Ape Yacht Club, and then you got 400 uni tokens that were worth, you know, $400, the basis of your Bored Ape Yacht Club is reduced by the
So
400.
let's keep the left. So,
oh, well, you have an inducement for just joining Uniswap.
Yeah, so Uniswap is just like you didn't know it was coming. You were able to claim it as a benefit after you had used it without knowing.
You might be able to fall under rebates. The problem is that there's no real purchase of anything except for maybe a membership, which the membership is an intangible, and it kind of doesn't really have.
Well, let's get to the next slide then, because I think we had talked differently that the Uniswap.
Let's settle this up by saying the receipt of the uni token is probably taxable based on the value of the uni tokens, probably.
Yeah. Whereas if you own a
may
Bored
be
Ape,
able to put a fancy argument together saying it's not taxable, but it sounds taxable. As long as the uni tokens do have an established fair market value. If they don't have an established fair market value, it's not taxable because the value of it is zero, or at least you don't owe tax on it, right? So that's what I would say about the uni tokens. The different stages of airdrop that you have on the screen, however, right? It's the next slide that you have here. This is probably peak levels of interesting. And this is where I think all of this stuff is unresolved in tax world and is really, really thorny. Okay. When do you get the airdrop? Do you get the airdrop having absolutely no clue the airdrop is coming, and the airdrop is not, it's not being traded anywhere? You can't really figure out what the fair market value is. It's probably going to be the receipt of a zero value property, and you'll have a basis of zero, but you also won't have any taxes, right? It's a brand new, the Bored Ape Yacht Club, the Bored Ape Kennel Club, right? If you, the very, very beginning where the Bored Ape Kennel Club is not being traded anywhere, you can't really establish its value, that you probably have a zero basis in it, and you probably don't get taxed. If you know that the airdrop is coming, right? At that point, the way I see it, you have to allocate basis between the Bored Ape Yacht Club and the Bored Ape Kennel Club at that point. The main NFT you bought and the airdrop that you're going to get. Because if you know for a fact you're receiving the airdrop at that point, you're not really buying one NFT, you're really buying two. And if you can establish the FMV of the other one, you probably have to allocate basis proportionally. So if you paid 1,000 worth of ETH, okay, and the Bored Ape Yacht Club was trading at the same level of ETH, but you also got Bored Ape Kennel Club, and the Bored Ape Kennel Club was worth a quarter of the value of the Bored Ape Yacht Club. You would have 80% of your $1,000 basis, or $800, be allocated to your Bored Ape Yacht Club, and the remaining 200 gets allocated to the Bored Ape Kennel Club. And that is the way I feel that it ought to be treated. And again, a lot of this is opinion, because the IRS has not even come close to touching any of this, right? Now, what if you own the NFT and they give you an unexpected airdrop like 3 years after you bought it, right? If the NFT that you receive in the airdrop has an establishable fair market value, that's probably going to be the same as a hard fork, and you're probably going to get taxed on the receipt of it, because you're getting valuable stuff for nothing. And a lot of the case law says that when you get valuable stuff for nothing, you get taxed to the extent of the value. And that to me seems pretty clear, right? And then at the end of the day, if you receive any airdrop that's got crypto or cash equivalents, that is easily taxable, because the crypto has an establishable value. The cash is obviously just cash. So any of that stuff is taxable. And if you have a contest, apparently there's a lot of contests out there in which you win an airdrop. I don't think there's any question that the value of the airdrop is ordinary income to you, because you went out there and you did whatever you needed to do to win the contest, and you got something valuable just for winning the contest. So that's my take on each of the different scenarios that are outlined here. And again, the IRS hasn't commented, so this is just me saying, General tax concepts. How does it apply to all this stuff? That's the best I can do.
So potentially each different one of those, it may be announced, it may be unannounced, it may drop without a market value, like it's just not traded yet. It's a new thing that comes into your wallet, and it may have some established value. Potentially all these different things lead to different tax consequences.
Yeah, and Nick is asking, you get taxed on an airdrop even without selling it. And what I'm saying is, in some scenarios that I just described, yes, again, insane. When you're somebody who's not in the tax world and you don't understand these concepts, that strikes you as totally insane, right? That is totally insane. Chris, hi Chris. Chris is on here. Chris says, what about the anticipated value and how does that hold up? What about stock option incentives? But stock option incentives have a whole statutory regime dedicated to them with special rules in it, right? It's all of that is special rules. And in addition, what Chris is saying is, Chris puts together the startup employee analogy, but that is receipt of property in exchange for services. None of this in the NFT world involves property in exchange for services. This is property in exchange for crypto and airdrops that are being done just out of consideration of the idea that you bought something. There's no services here, right? The holders of the NFTs are not rendering services. That's the difference between the world of stock option incentives and the world of NFTs, that one of them has a whole clear statutory regime with special rules that go beyond general tax concepts. These things don't. So that's an important thing to make clear.
Okay. Yeah, we were talking about how, well, do you need to get an expert to establish the potential value of the NFT at the time of the airdrop? Because every airdrop, there's no value until it starts trading, and there's a price discovery process, and who knows? So and
let me tell you something. There's expertise out there. There's persons who appraise real estate for a living, art for a living, and there's enough money in NFT world that you could have an expert appraiser of NFTs. But for your claimed value of an NFT to hold up with the IRS, they're not going to take your self-serving assessment. They're going to say, do you have an expert who can go in and evaluate? And I don't know of any people who are specially credentialed or licensed to do any of this. You're going to have to establish the reason why somebody else's evaluation of this is valid. But at the same time, if you've got, if the IRS can get a screenshot of the trading value of a particular NFT or set of NFTs, if they can get some comps up together, they're going to wave that in your face on audit. So when you exchange the NFT on the left for the NFT on the right, or even a Bored Ape for another Bored Ape, that's taxable. Exchange of a unique property for another. If you exchange two cars for each other, that's taxable. It applies to anything in the even in the physical world. You exchange one unique item of property for another, it is taxable. You would need the items to be fungible. So if I have the exact same 2020 Toyota Camry and exchange it for the exact same model of 2020 Toyota Camry, but they have different VIN numbers, I might argue that's not taxable because they're fundamentally the same property. But two NFTs, you'll never be able to argue they're the same property. This is taxable, what you see in front of you.
It's the same example. You have 2 for 1, same deal, right? You just have whatever your basis is in each of the two, swapping for the other.
Yep. And you'll have a recognition event on the 1178 and the 8505 separately. You'll have a basis for one, a basis for the other. You'll split the amount realized with according to aggregate market value of the pig, and then you'll tabulate your consequences accordingly.
Okay, what about fractionalization? I don't want to sell my Fidenza. I want to sell 49% of it and maintain 51%. So implied valuation here is 5 million. I'm going to keep, about half of that in Fidenz tokens I'm creating. How, as the owner and seller of this, what should I be thinking about?
So fractionalization of any, pretty much anything, whether you've got fractionalization of an NFT, fractionalization of real estate, you get back into the things we were talking about with liquidity pools. Do you have a partnership or do you not? I gotta tell you, fractionalization could very well be a partnership, especially if I am retaining certain governance rights over the artwork by keeping 51% of an interest in it, right? Very tricky question. However, if I fractionalize it and I've said that I give you an ownership share, in the real estate world, there's tenancy in common, which says we're not in a partnership. We just happen to own the thing in slices. Fractionalization could apply the tick model to the NFT that you see here. You got Fidenza 527, I'm going ahead and I'm taking 49% of the interest and I'm fractionalizing them so that folks can own a tiny little piece of it. First and foremost, for the original owner of the Fidenza, every sale of that interest is taxable, right? So that should be clear. Every time you sell a fractionalized interest of a Fidenza, it's taxable if you own the whole thing beforehand. Number two, by the time that you buy the fractional interest in the Fidenza, you could say I have an undivided slice of the Fidenza without being in a partnership for tax purposes. But I'll tell you what, I mean, it's a thorny question. And the first thing the IRS is probably going to ask is this a partnership? And the answer is going to be, it depends on whether or not one particular person has any power to do things related to the Fidenza. Let me give you an example. If you fractionalize the Fidenza and the 51% owner of the Fidenza has the power to sell the entire Fidenza to somebody else, not just his 51% interest, that shows a partnership. But if the 51% owner has no power to do anything related to the Fidenza and can only buy and sell his own 51% interest, tends to show that's not a partnership, right? But the sale of the fractionalized interest is taxable, probably as a capital gain. But you start getting into questions if you fractionalize a Fidenza of, are you a dealer? If you fractionalize 7 Fidenzas, you really risk the idea that you're now a dealer in Fidenzas. For tax purposes, if you're a dealer in Fidenzas, that's ordinary income instead, right? That's a thorny question too. So, the fractionalization brings up super, super interesting issues. And under general tax principles, that's the stuff that the IRS is going to be looking at.
Okay. I've heard a lot about wash
There's a
sales.
lot.
Yeah, go ahead.
Sorry, Moish. If I could hop in for a sec. There's a lot of questions about floor pricing and finding the fair market value at a specific time. Something to keep in mind, that's its own kind of messy issue, because importantly, the floor isn't its fair market value at the time, right? The floor is the price that people are not paying. So really your fair market value is below that floor, and it's questionable as to, what is the fair price to put on that when you are engaging in a trade. And again, it's a complicated question. You can get different levels of aggressiveness in your pursuit of this, but that's something to keep in mind.
Yeah, and that's exactly the right take. The floor value will not control. You are going to need to prove to the IRS why your measure of fair market value is correct, and you're going to need some kind of evidence for that. You could talk about comparable sales. There's a lot of stuff that you do in real estate. When you value real estate without disposing of it, happens in the estate world, it happens in a lot of different worlds. How do you establish a fair market value of an NFT? That's an unresolved question, but you're going to really need to make a persuasive case to the IRS based on evidence, based on logic, and not based on your own subjective judgment. Moish, I'm going to comment on wash sales for 1 second. I've seen a lot of commentary out there saying that since the IRS in their 2014 notice said that they're treating crypto as property and they're treating NFTs as property or whatever, well, this really only applies to crypto. If you sell crypto and then pick up the same crypto a minute later, do you get to book any inherent loss you have in the crypto? So if I buy ETH at $1,000, but it dips down to 800, can I sell the ETH for Bitcoin, go from Bitcoin back to ETH at $800 and book a $200 loss? A lot of folks are out there saying unless Congress changes the rules, the answer is yes. I don't think they need to change the rules personally. I think that a wash sale can be disallowed because what it says is this is applicable to securities and they don't define what securities are. Do not be surprised if the IRS has a wash sale big enough that they're dealing with. Do not be surprised if the IRS turns around and says, for purposes of this section only, the wash sale section only, we think it's a security. You shouldn't be allowed a wash sale. Not only that, don't be surprised if Congress changes the rules because this is abusive. The wash sale rule is out there to prevent the abuse in stocks and bonds. Do not be surprised if they pass the same rule for crypto, and do not be surprised if the IRS takes an interpretation of the current rule that says wash sales apply to crypto, and you're not allowed to do this. Be very careful with this.
Okay, and then I think we're getting to the point where we're perhaps a little bit forward-looking, right? So, what can you do? Is there an advantage to saying I am an NFT dealer or investor? That's my full-time trade or profession.
Yeah. And this
and
is,
how,
I'll take everybody through this for just a moment, because I think everybody's got to go at this point. We really appreciate you guys sticking around with us past the allotted time, and we hope you found everything helpful. But I'll finish off with this. In crypto and NFTs, you generally, for tax purposes, you can have 3 different statuses. You can hold crypto and NFTs for mere personal use as a hobby, right? That's probably the default. So if you're just in there buying a couple of NFTs and just kind of hanging on to them, and it's occasionally you turn around, you sell one and whatever, it's probably personal use. In personal use, you can't deduct your investment expenses. Like we talked about the $10 fee to transfer wallets. If you're holding your crypto or NFTs as a mere hobbyist or personal use, that type of stuff isn't deductible, right? However, holding as an investor, to establish that you hold your crypto or NFT as an investor, you need to treat it like an investment. You need to be tracking financials. It would help to set up an entity, right? If you have an LLC, you have an S corp. I don't know if I'd recommend an S corp for this, but something like that. And you're tracking financials. You're tracking budgets. You have a separate bank account. You're tracking the market values of these things and making occasional sales and tracking things not for how cool they are, but for whether or not they're going to increase in value. Those are the hallmarks of investor treatment under the case law. And for the record, that's the same thing with horses. You talk about, the Zeds and the horse racing. The thing about horse racing is if you own a stable and you kind of like care for the horses, but you never make money racing the horses or whatever, you only occasionally race the horses. You can't deduct the expenses related to the horses because it's a hobby expense and that's not deductible. In an investment expense, however, investment expenses are deductible, right? For the most part. And investment gains are capital gains. Now, for NFTs in particular, there's a special rate for capital gains on collectibles that is 28%. The highest rate on regular old capital gains when you're in the super bracket is 20% at the federal level. For collectibles, it's 28%. NFTs are going to be considered collectibles in my opinion. So when you have NFTs and you're an investor, you can sell them, and the 28% collectibles capital gain rate is still not higher than the ordinary rate. If you're a dealer is the factors you see here, right? The 1 through 6 under the first portion of the slide. If you're a dealer in NFTs, what does that mean? That means that you're constantly buying and selling the NFTs. You're constantly offering them for sale. You may even be in mass creating them yourself. That's really when you're a dealer. When you're a dealer and you're going out there and you're really holding these things, not for any level of investment or appreciation, but to really go out there and to start flipping them on a frequent basis, those sales are ordinary income because the NFTs are now considered to be inventory for tax purposes, okay? And those factors are out there. We don't have enough time to explain them, but if you want any further explanation, you can always feel free to contact us and we'd be happy to take some time aside. But that's how tax status works, and that is absolutely relevant to this, even if the IRS has not gotten around to litigating it yet. This is relevant stuff.
okay, so we'll just quickly recap. I think we have a couple of things, which is just generally speaking, we have a picture here of,
the Beanie Baby divorce,
splitting up their Beanie Babies. Be thinking about, how you're structuring your estate plan. If something were to happen to you or you're incapacitated, who is someone else? Do you have a plan for, allowing your successors to access your potentially very valuable NFTs? To be kind of thinking about what your future is there. And then, the other thing is be thinking about how you're going to be reporting your taxes. I presume a lot of people didn't have much NFT transactions before this year, and this year are going to have a lot of transactions and potentially a lot of transactions with a lot of value represented there. So be doing the things here, right? Keep good records. Let's try and find some good tax tracking software. Don't play around, right? Anything else?
By the way, the IRS, when you go to court against them and you try to argue with them, it's preponderance of the evidence. The IRS's assessments are presumed correct unless the taxpayer can prove why they are incorrect, and burdens on you. So you better be ready, because if they think you're playing funny business with them, they have the ability to do a lot, even if they can't get the whole story from you right up front.
Okay, so we have some potentially future regulatory clarity would be great for, I think, everything in the crypto ecosystem. But it seems like that's not coming down the pipeline anytime soon, and we'll keep our fingers crossed. Lastly, we have an announcement, which is our firm has secured a parcel in Decentralized, where we're going to be, if it's not already out there, I think it might be right now, launching our virtual law firm. And we'll have more information on that to come. You can.
This is the coolest thing we've ever done, by the way. I mean, we've done a lot of cool stuff at this law firm, at least if you're nerds like us. This is the coolest thing ever. We have an office in Decentralized. It's a whole skyscraper and everything.
So we're going to have a launch party, an event. Everyone that registered interest in this event will get an email with more information on that. We'll also be, I think, converting a lot of the stuff we've discussed and prepared for today into written recommendations in the form of like a white paper, things like that, which we'll provide links for. We will just be providing more information. I see a question. Do you provide decentralized advice? Yeah, we provide advice on everything in the NFT world. We help businesses get in there. We help people that have complicated problems figure out, please, this kind of leads to the last slide here.
We provide advice across virtual borders and physical borders. We do international stuff here. We do virtual stuff here. We try our best to cover the whole thing here. So
there were a lot of questions. We couldn't get to everything. We already went way over time. So if you have any questions, please email us. We'd love to find some time in a different forum to discuss your particular issue with you in more detail. And I think that's really it. Any concluding thoughts, Matt?
Look, this is the most fun I've ever had exploring tax topics. I'm not even exaggerating, okay? I'm a big tax nerd, all right? I've done a lot of tax stuff. This is the most fun stuff ever. The whole thing is brand new. Nobody knows how to treat any of this. Putting our necks out there and saying, listen, this is the way that we believe all of this stuff is going to be treated is about the coolest thing I've done in an 11-year career so far. And we'd love to do it individually with some of you folks.
And I can say the same thing on the IP and business side. This has been the most interesting and exciting 8 months of my career. And I think it's we're all very early. Everyone here in this webinar is early, and we're just getting started, and looking forward to seeing everyone. All right, that's it. Thanks everyone for coming by.